Right now, two major headlines are dominating trading desks around the world, yet almost nobody is asking why they seem to completely contradict each other. On one side, inflation in the United States has cooled dramatically. On the other, expectations for another Federal Reserve rate hike have surged in just a matter of days. Those two developments are not supposed to happen together. When they do, it usually means something much bigger is unfolding beneath the surface. Welcome back to Ag John Silver Update. Today we're going beyond the headlines to uncover what is really driving this market and why it could explain the massive disconnect investors are seeing in silver right now. As of July 25, 2026, silver finished its latest trading session just under $59 per ounce, a stunning decline from the record highs reached only 6 months ago when prices briefly climbed above $121. That represents a drop of roughly 52%. Gold has also pulled back from its January peak, but its decline has been much smaller at around 27%. In other words, silver has fallen almost twice as much as gold. The question is, why? Most people believe they already know the answer. They blame profit-taking, weaker demand, or changing investor sentiment. While those factors matter, they don't tell the full story. The real explanation is far more complicated because two completely different forces are fighting each other at the same time, and both are influencing silver in opposite ways. One battle is visible every day in the news. The other is taking place deep inside the physical metals market, where supply and demand continue telling a very different story. Understanding both is the only way to make sense of what's happening. Let's begin with the geopolitical picture because it has changed rapidly over the past few weeks. Many investors assumed tensions in the Middle East had eased after the temporary ceasefire between the United States and Iran earlier this summer. That assumption is no longer accurate. During the first week of July, several commercial ships passing through the Strait of Hormuz came under attack. The United States responded with military strikes, and President Trump publicly declared that the previous agreement had effectively ended. Since then, military operations have intensified, including multiple waves of American airstrikes on Iranian targets. Iran answered by once again declaring the Strait of Hormuz closed until what it described as foreign interference comes to an end. The conflict quickly expanded beyond Iran itself. Groups aligned with Tehran announced restrictions on maritime traffic linked to Saudi Arabia, and attacks on commercial shipping followed shortly afterward. Vessel traffic through one of the world's most important energy routes has dropped sharply, leaving thousands of sailors stranded while disrupting a significant share of global oil and liquefied natural gas transportation. Instead of calming down, the situation has continued to escalate, creating a new layer of uncertainty for financial markets. And this growing geopolitical crisis is only the first half of the story. The first reaction across financial markets was exactly what most investors expected. Oil prices surged as concerns over the Strait of Hormuz intensified. At one point, crude climbed close to $92 per barrel before giving back part of those gains and settling near $88. Even after that pullback, oil remained significantly higher than it had been only weeks earlier. Analysts have already begun discussing the possibility of triple-digit oil prices if shipping disruptions continue, or if military tensions escalate even further. Normally, that kind of environment would be extremely supportive for precious metals. History tells us that geopolitical conflicts, rising oil prices, and growing uncertainty usually drive investors toward traditional safe haven assets like gold and silver. But this time, something unusual happened. Silver failed to respond the way many expected, and understanding why is the key to understanding the entire market. The answer lies in one report that changed everything. While headlines focused on military developments, the latest inflation data told a completely different story. June's Consumer Price Index surprised economists by showing inflation cooling much faster than expected. Annual inflation dropped to around 3.5%, well below forecasts and significantly lower than the previous month's reading. Energy prices actually declined sharply during June, while core inflation also continued to ease. Shelter inflation slowed, services inflation softened, and several categories the Federal Reserve closely monitors all pointed toward improving conditions. If investors had looked only at that report, the conclusion would have been simple. Lower inflation normally increases the chances of future interest rate cuts. Lower rates reduce the opportunity cost of holding precious metals because silver and gold do not generate interest income. Under normal circumstances, that should have been a very bullish signal. But markets do not trade the past. The CPI report measured what happened in June. Investors were already looking ahead to July, where oil prices were rising rapidly because of the renewed conflict in the Middle East. Traders realized that today's lower inflation could easily become tomorrow's higher inflation if energy costs continued climbing. That completely changed expectations for Federal Reserve policy. Within just 1 week, the probability of another rate hike in September jumped dramatically. Futures markets rapidly increased the odds of tighter monetary policy, while prediction markets also showed traders becoming much more confident that the Fed would stay aggressive. Although policymakers were still expected to leave interest rates unchanged at the July meeting, investors increasingly believed rate cuts were being pushed further into the future. Some even began pricing in the possibility that there would be no rate reductions at all during the remainder of the year. This is where everything connects. The military conflict pushes oil prices higher. Higher oil threatens to reverse the progress that inflation has finally started making. If inflation begins rising again, the Federal Reserve has little choice but to remain hawkish or even tighten policy further. Higher interest rates strengthen bond yields and increase the attractiveness of interest-bearing assets. That environment naturally creates pressure on precious metals, especially silver. In other words, silver is not falling because its long-term story suddenly disappeared. It is falling because the interest rate outlook surrounding the metal has become far less favorable almost overnight. That creates one of the most unusual macroeconomic environments we've seen in years. Instead of geopolitical risk supporting silver, the conflict is indirectly hurting it by increasing the likelihood of tighter monetary policy. The same event that would normally send investors rushing into precious metals is simultaneously encouraging expectations for higher interest rates, and those two forces are pulling silver in opposite directions. Many investors are still following the traditional playbook that says war automatically means higher gold and silver prices. In today's market, that relationship isn't nearly as straightforward. The Federal Reserve's inflation battle has become just as important as the geopolitical crisis itself. But here's where the story becomes even more interesting. Everything we've discussed so far explains the movement in paper markets, interest rate expectations, and investor sentiment. Yet none of it has changed the underlying physical silver market. Not the mine supply, not long-term industrial demand, not the structural shortage that has been developing for years. And once you look beneath the surface, you'll discover a completely different picture, one that may eventually matter far more than today's headlines. What makes this situation so fascinating is that the physical silver market has barely changed, even though the price has been cut in half. If you focus only on the chart, it looks as if the entire bullish story has collapsed. But once you examine the underlying fundamentals, you find a market that still looks remarkably tight. Global mine production has remained almost unchanged for more than a decade, holding near the same annual output year after year. Recycling has also struggled to grow because recovering silver from scrap is often too expensive to justify. In other words, supply has not suddenly increased just because prices have fallen. Meanwhile, the broader market continues to consume more silver than it produces. According to the latest industry projections, 2026 is expected to become the sixth consecutive year in which global demand exceeds combined mine and recycled supply. Over that period, hundreds of millions of ounces have effectively been drawn from above-ground inventories just to keep the market functioning. Think about that for a moment. A metal experiencing years of structural deficits is now trading almost 52% below its recent peak. That disconnect alone tells you today's price is being driven by forces beyond simple supply and demand. Of course, it's important to stay objective. The bullish argument isn't perfect, and ignoring the risks would be a mistake. The explosive rally earlier this year was fueled not only by fundamentals, but also by aggressive leverage. Markets rarely move more than 200% in such a short period without speculative money amplifying the trend. Once sentiment reversed, leveraged traders were forced to liquidate positions, creating a wave of selling that pushed prices much lower. Some highly leveraged positions reportedly lost more than half their value in a single trading session during the worst of the correction. Demand also softened in several important sectors. Solar manufacturers reduced the amount of silver used in each panel by improving production efficiency. Jewelry demand weakened across several regions, and silverware purchases declined as consumers adjusted to higher prices. Those changes are real and deserve attention. But here's the detail many headlines overlook. Industrial demand as a whole remained exceptionally strong. Even after the slowdown in solar consumption, total industrial use still reached record levels thanks to continued growth in electric vehicles, artificial intelligence infrastructure, data centers, electronics, and power grid expansion. Instead of disappearing, Demand has simply shifted toward different industries. That distinction matters because efficiency improvements are very different from permanent substitution. Solar companies have mostly reduced the amount of silver required in each panel, rather than eliminating silver completely. Engineers can continue making incremental improvements, but there are practical limits. Silver remains one of the most effective conductive materials available, and replacing it entirely with alternatives like copper still presents technical challenges that are unlikely to be solved overnight. Now let's look at another number that's becoming increasingly important. COMEX inventories remain relatively tight compared with the enormous amount of paper contracts trading every day. Only a fraction of the silver represented by futures contracts is actually available for physical delivery. That imbalance isn't unusual by itself, but it becomes much more significant if a large number of investors suddenly demand physical metal instead of simply settling contracts financially. I'm not predicting a delivery squeeze tomorrow, but it's one of the most important indicators I'll be watching over the coming weeks because it has the potential to move prices independently of whatever the Federal Reserve decides. Another market worth paying attention to is India. Despite softer overall demand, physical silver continues to trade at elevated premiums in many parts of the country due to import restrictions and limited local supply. Normally, weaker demand would push premiums lower. The fact that premiums remain elevated suggests supply constraints are playing a much bigger role than many investors realize. When you combine that with a gold-to-silver ratio still sitting above its long-term historical average, it becomes clear that silver continues to trade at a significant discount relative to gold. Right now, the market is treating silver primarily as an industrial metal that's vulnerable to higher interest rates rather than as a monetary asset. That perception can change surprisingly fast. History has shown that when investor sentiment shifts back toward precious metals, silver often moves much more aggressively than gold because its market is considerably smaller. So where does all of this leave us? I believe the January rally clearly became overheated and needed a correction. But I also believe the long-term structural story hasn't disappeared. The biggest influence on silver over the next few months probably won't be mine production or annual deficits. Instead, it will be the relationship between oil prices, inflation expectations, and Federal Reserve policy. If geopolitical tensions continue pushing energy prices higher, interest rates could remain elevated for longer, keeping pressure on silver. On the other hand, if inflation resumes its downward trend and expectations for tighter policy begin to fade, the combination of persistent physical deficits and tight deliverable inventories could allow silver to recover much faster than many people expect. For now, I wouldn't focus on predicting the exact bottom because nobody consistently gets that right. I'd focus on risk management, building positions gradually, avoiding excessive leverage, and understanding that short-term price action and long-term fundamentals are currently moving on two completely different timelines. One is measured in weeks, the other is measured in years. Eventually, those two stories will meet. The only question is, which one changes first? Until then, I'll continue watching the physical market just as closely as the headlines because, in my view, that's where the next major signal is most likely to appear.